Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that some people probably just wish were close today. I'm your host, Steven Van Metre, and thanks for joining me today. We've got the Fed to talk about, currency wars to talk about, economic data, but many of you probably would wish and are hoping that we can just forget some of that stuff and talk about what actually happened in the market. Say, well, we're going to do that, but we need to go back to last night and figure out where this started, because we've been talking about how gold mining stocks are a proxy of liquidity. And we're going to look at that today. And a fan of the show, I don't know if they're psychic, but messaged me and said, hey, can you do a TLT VIX overlay? Man, timing of this couldn't be better. But we have to understand where this all started. And it started last night. Now, where did this come from? Well, the last 2 days, let me preface this. The last 2 days that I recall, China has been pulling liquidity out of the market. Now, what should that do is put upward pressure on the dollar. And what we see today, stocks down, yields down. This is what we would want to see. And yields are threatening a big move. The VIX is threatening a big move. And the dollar's starting to move. And bonds, everybody is starting to threaten a big move in the market, and nobody is hedged for this. And that's what makes this interesting. Now, so what happened last night? We have to go to the ECB, and here's an article on Zero Hedge. This is Euro slides after the ECB signals potential for currency wars. Now, keep in mind, in the trade-weighted dollar, symbol DXY that we look at on the show, many of you look at as well on your trade screens, guess what the largest component is in the trade-weighted dollar? The euro. And so I'm not worried about this headline here, but we do know the rest of the world is not enjoying the dollar depreciation. And so here we see with the euro recently soaring back to 6-year highs, which keep in mind is deflationary for them, inflationary for us, but it's not really leading to inflation, but it's really deflationary for the Eurozone. ECB Governing Council member Klaus Knott told Bloomberg this morning that the central bank had the necessary tools, including interest rate cuts, to prevent any further strengthening of the euro, undermining inflation. This is something we've talked about on the show. We did that whole special on, I did a show on the China deval or potential deval coming, because the U.S. does not have the tools or ability, the Fed does not, the Treasury does not, the U.S. government does not have the tools or ability to devalue the dollar like other countries can, because they're pegged to the dollar. So if they want to devalue, they can do it in multiple different ways. And this is the one thing the market is not prepared for. U.S. investors, U.S. equity markets are not prepared for this. And I said it was only a matter of time before this happened. And here we see it in this article. That is something that we, of course, monitor very closely. Knott said, who heads the Dutch Central Bank, said in a Bloomberg interview on Wednesday. It's one of the factors, not the exclusive factor, but one of the factors we take into account when arriving at our assessment of where inflation is going to go. And so that means that, and you see down here this quote, there's still room to cut rates. People thought the ECB was done. And what did that do? It sent the dollar higher. Now let's go look at a chart of the dollar. I already had the VIX chart loaded up, but we'll come back to that. What happened with the dollar is it shot up and hit its 50-day moving average. This little move in the dollar, this 0.5% move, sent equity prices down over 2% across the board. Imagine what happens if my thesis plays out the way I think it is, and the dollar goes over 103. Because of its relationship to bond prices, which I think are headed to new all-time highs as yields are going to head to zero. So this is where it started. Now, the next phase of all of this is we have the Fomc meeting today. Now, because we had the Fomc meeting, there was no asset purchase program for the Fed. So tomorrow there will be one, and then on Friday there's the last one for the month, and we get the renewal schedule. So what did we learn from the Fed today? Well, let's go to the Federal Reserve website, and we found out that they're going to continue paying interest on excess reserves. And this comes back to that liquidity trap in yesterday's special video, is the Fed is paying, and what the article said, look, they're paying interest on cash or excess reserves. This is a problem. The Fed is stuck in a liquidity trap. They can't get out of it. They're going to continue down this path until they break the markets, and we're starting to see liquidity dry up, as we'll get to shortly. So what happened in here? No change to the federal funds rate. No change to the asset purchase programs. In fact, no change to anything. They're going to keep doing everything they've been doing. The only thing they changed was that the 1 month term repo operation scheduled for February 2nd and 9th will be the last regular scheduled term repo operation. So we're going to go and have only available overnight repo. And if you're listening and saying, I don't know what an overnight repo is, does the Fed repossess things? No, it's an overnight dollar loan where the Fed will take Treasury and mortgage-backed securities on collateral for a dollar loan. So we're going back to, back in March of last year, we had these term dollar loans where the Fed gave primary dealer banks and commercial banks that had treasuries, multiple months to pay these loans back. So we're going back just to the overnight data. So we saw the market start to go down. Now let's go take a look at that, because I know that's what we're all interested in today. Let's just look at the largest ETF for the S&P 500 SPY, and it started down, it fought back up, came back down, and then it was kind of rising into the Fed meeting, hoping for some Fed candy, and then boom, no. And you can see in after hours trading, this is headed lower, and my guess is bond prices probably are headed higher. I want to talk about that for a second. So a lot of people started asking, well, Steve, wait a minute, you're the bond king. Oh yeah. And why didn't bonds react more today? Because the market hasn't figured out what's coming. The market still thinks this is okay for the moment. And the other factor you have here is that people are really deeply short. So the CTAs and quants were not back at their trigger point. But one thing we are going to probably see when this after hours trading is very interesting. Now, of course, it'll be interesting to see if it comes back up before the futures markets open. But there's something out there, there's products out there called volatility controlled strategies. Now, if you owned an annuity, like a variable annuity, you might actually have this in it. Some fixed annuities have it, and some managed strategies have it. And not all of these work on an intraday basis. So what these strategies do is when volatility rises, so we'll get our bull arrow up. So when volatility goes up, these strategies say when you hit certain trigger levels, here, and here, sell. So if it's a diversified portfolio of stocks and bonds, it will sell both of them. Now, sometimes, depending on who manages these strategies, they will sell to a different bond fund. Sometimes they just go straight to cash. And as the higher volatility goes, the more of these trigger points that are sold until these strategies get sold. Now, here's what's interesting. There aren't a lot of these that do intraday selling. There's a lot of them that do daily after market close, because they have to read, the formula is reading what it needs to do. It sees that volatility spiking, going into close, and it starts to trigger a sell. And then the next day, because it hit that trigger point, it's going to sell again. And some of them are weekly, some are other weeks, some of them are monthly, but a lot of them are daily. So when I see this overnight selling here, it doesn't really surprise me. Now let's look at the VIX and what happened. Of course, the VIX is up in overnight trading, so that would suggest that there's some truth to that. So look what happened. Look at what has happened with the VIX. Nobody was carrying any form of portfolio insurance, and boom. And now we're potentially setting up for a bigger move than we had in March of last year. We're potentially setting up for this because where we're at with the bond market, and let's go to the 30-year here and zoom in. This rounding top, you can see, and let me draw a line in there for those of you who need a little visual reference. You can see right here, well, that was not the best line I could have ever drawn, but you can see where we're about to have a technical breakdown on yields, where that overnight gap in the Georgia election where yields gapped up. You can see, look, today the yields came down, hit that support level, and bounced off of it. This is where the CTAs, based on the last known data, would buy. Right down in here, they start to become buyers again. So the market's fighting against this, needs to hold this, but it's likely going to head lower. When the CTAs come back in, which would help because the volatility control strategies based on today's move in the VIX are likely to sell. And I don't know exactly how the formulas are written, but when you get big moves in volatility, they're going to sell. Now, we already know liquidity is drying up. And let's go look at GDX. Now, this is real interesting because this afternoon I'm going for a walk around the world with Martin North. Big fan of him. I know a lot of you are too. Last year, you might remember I went on Palisade Radio Show. And I'm going on, I'm going back on next week. And when I went on there, some of you may remember this. I said, look, I don't think this is the big move coming. I think there's still a pullback. And I said, look for miners. And you go back in this episode, I said, look for miners to go back and test their potential low, which was on GDX. I said down here in the 20s, low 20s, or even 18 to 20. I said, I think this is going to happen. Now, as many of you know, because I do have a business friend, I don't always have time to look in the comments, but my wife, my father, they do. That night when I got home from work, and my wife has never said this about any interview I've ever done. She goes, did you look at the comments from your interview? And I said, I haven't had a chance to. She goes, don't. She goes, they were the most hateful comments I've ever seen. Essentially, I went into a gold club and said, look, this thing is going to go down before it has its big move. I want you to look at this chart today because that prediction may actually get blown through. It may go lower than I think. So here what we have in GDX, let's zoom out to the 1-year chart, is you see this support level here. And look what happened. You see this big move down today, almost 4%. And it's threatening this level here. If this breaks down, now you're going to see a lot of selling. It feasibly could blow through this March low. It's possible it could go way down. And many of you know that what happens after that becomes a massive buying opportunity. It's possible it could get down there. It may go lower, it may just get to that level. And I said it would be perhaps one of the biggest buying opportunities ever. But here you can see it's threatening the support level, and liquidity, this is a proxy of liquidity, and it's telling us something in the markets is really, really wrong. Now let's go look at that VIX overlay that came in as a request. And because some people are like, hey, aren't you worried the bonds aren't going to, the bonds didn't react today? Well, the flight to safety hasn't happened. But if you zoom out, what you can see is that when the VIX goes up, there's where you get the tightening of liquidity here. So here's that liquidity crisis. Bond prices, boom, then they go. So you can see bonds were already rising a bit. And that's what I thought right here. That move in the treasury yields here, this little top here, I thought, man, this could be a problem because the market needs higher yields. And if they come back down, it's going to tighten things. In fact, the dollar's going to rally and things are going to get really ugly. Now let's go back to the VIX here. And so what happened? Bond prices started to go up a bit. Volatility is spiking. What happens if we go back far enough? Here is the great financial crisis. And in purple, you see bonds. Am I worried? No, because as soon as volatility starts to take off, guess where bond prices are going? Up, up, and away. So we're sitting on the potential here for a major, major unwind in the market. You have threats of currency wars. It'd be interesting to see if China continues to pull liquidity out of the market tonight. But this is a real threat because nobody's hedged against this market. It's dangerous. Now let's get into let's go into the economic data. I hope this helps. Hope it makes sense because you're seeing this liquidity trap the Fed's in, and see who's causing this problem. All right, on to the economic data. So what do we have here? Let's see, find some interesting stuff. Spanish PPI going to Tuesday, minus 1.4%. So still exporting deflation, but not as much. It went from minus 2.8, minus 1.4. Red Book, same store weekly retail sales. Now I was kind of interested in this because remember we had that pop in the money supply that everyone's like, oh, it's going to be so inflationary. And I'm like, I'm not convinced about that at all. So you would think with all these stimulus checks going out, what would you expect to find? Same store weekly retail sales go up. They didn't. On a month over month, down 2%. Year over year, it did go from 2.2 to 3.9. Nowhere near it's like 6 to 8% numbers we've seen last year. So no major purchase is coming from out of the Red Book. Maybe we'll see them this week. In next week's data, I don't know. Housing prices continue to go up, although many of you know I'm bearish on housing prices during insolvency events. Year-over-year basis up a massive 11%. Conference Board Consumer Confidence Survey up a little bit. People get excited about, oh, it's up. But look, in the grand scheme of things, no, it's not in a good place. In fact, it's at a point that's telling us if it doesn't go up, we're headed into a big market meltdown, financial crisis. Stocks are normally fairly correlated with consumer confidence, but not right now. How about the Richmond Fed Manufacturing Index? Disappointed, was supposed to come in near the same level as last month at 19, came in at 14. Here's the survey. Now let's go look at some of the details, because what we're seeing out of the Fed surveys is things are slowing down and they're not rolling over, but they're slowing down. And keep in mind, each index equals a percentage of responding firms reporting an increase minus the percentage recording a decrease. So we're seeing across the board still an increase, but a slowing level. Look at the overall index. November of 15, then December, everyone's like, okay, the economy's rebounding. 19, bam, down to 14. How about shipments? This was a big problem. Shipments were getting backed up. November 20, down to 12, down to 10. So that's starting to go away. Volume of new orders. Remember in December, 12 to 24. This was it, right? This is that pent-up demand. New order back down to 12. Backlog of orders. Now, this is really where you start to get inflation in the factory sector. Went from 11 to 17 in December, and now down to 6. Capacity utilization. How much of the factory is being utilized? 14, 15, down to 4. So we're not seeing any push in inflation from a capacity side. Vendor lead time. Now that's way up. Local business conditions went from 21 to 4 to 10. So that's pretty bad. In November, they were better. In December, they were worse. In January, they're slightly better. Capital expenditures, no big move there. They're sitting at 5. Finished good inventories is declining. Raw materials is rising slowly. And equipment and software spending is down. Services expenditures are down. Number of employees are up. So 13, 20, 23. Be interesting to see if that holds. But look at wages. 25% of our firms reporting increase in November, 32 in December, and 21. So that's slowing. Available skills needed. That's never actually good. And average work week, went from 9 to 16. So here you see the factory sector getting excited. Like, okay, seen a rebound. Now the work week's down to 10. Only 10% of the companies showing an increase in the work week. That is slowing down. Prices paid is up. Everyone thinks this is okay. This does not predict future inflation. All these data tells us is just where we're at right now. You can look at the trend and maybe say there is a trend, but it doesn't mean there is one. But look at this. Prices paid is up. Prices received, not up that much. Went from $1.14, $1.76 to $2.09. Whereas prices paid went from $2.18 all the way up to $3.11. So what that's telling you is manufacturers are getting squeezed on the margin. Let's continue on. Let's see. Australian CPIS quarterly. Don't really care. Oh, here, mean CPI. I ask all quarterly. I don't want quarterly. Year over year, Chinese industrial profit up 20%. Would say that's good for China. Moving into today's data. Let's see. German consumer climate, wow, that went bad, minus 7.5 to minus 15.6 in February. So what you're seeing is in Germany, or my browser not loading, so we'll just move on. Perhaps it's real windy here today, so maybe the internet is not functioning, but at least it will work while we record. Mortgage applications down 4%, nothing big there. Durable goods new orders, missing expectations, went from 1.2 to 0.2. In December. That's not good. I think this is going to be a problem because remember, we saw this massive rebuild in inventories, right? New orders up on pent-up demand. There's going to be all this pent-up demand. People buy. What's going to happen when these inventories, are we going to have a second inventory recession because there is no pent-up demand? The people are actually going to have to, lo and behold, go back and make, back mortgage, back rent, back other back payments, utilities, get caught up. Maybe they've already spent all their money. You have back-to-back weeks of 900,000 job losses. What's going to be tomorrow? Let's take a look at the last piece here is crude oil inventories were down massively, 9.9 million barrels. That's keeping crude pinned around 50 or low 50s. But what is interesting, gasoline demand is falling as inventories continue to rise there, almost 2.5 million barrels. Distilled stocks were down slightly, down 800,000, and Cushing inventories were down a bit. So the market, is really excited about crude oil inventories falling, but the problem is we're not seeing it in demand, and that ultimately is where it needs to be. Thank you all for being fans. I know I'm wearing that cool shirt that does the cool stuff that some of you really are getting mesmerized by. Thanks for being fans. Thanks for subscribing. Thanks for watching. We'll be back on Friday for the macro show, and got some special stuff I need to work on. Oh, I should mention, interesting. Some of you, messaged me about that momentum project I was working on. Here's something interesting. Every morning I pull it up. This is hasn't flagged this yet, but today, the first day, it said you should hedge your equity portfolio. So that was what it was recommendation before the markets open. Oh, wow, that's pretty ominous. Anyways, I'll see you Friday. Bye now. The content of this video provides education and information only. Information only is not provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling a security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. I'm not going to get a good rating on today's read of that.